Have you ever wondered while investing and looking for great and cheap companies to invest to, why not just hoard your cash and wait for a market crash to happen and invest all your money during that time, like what has happened in this pandemic? Knowing that market crashes do happen sometime averaging every 6 to 8 years. That way you know stocks are really cheap. You know they are selling at a bargain price. Now we will try to answer that question today. Should you wait or just keep on investing no matter what market cycle you are in? But before that, do like this video, and if you haven't yet, do subscribe to my channel. So let's start. Now this question came to my mind when I started investing. Am I buying at the wrong time? When I looked at the graph of the PSEI, it was still quite high. So then I wondered, should I wait for a crash to happen? Then another question came. What if I waited and the stock market kept continuing going higher? A lot was in my mind, but when I got into value investing and later on knew how to analyze companies, everything became clear. So should you wait for a stock market crash or correction to happen or not? Well, market correction do gives us more opportunities to buy companies at a bargain price. But the problem of waiting for a correction to happen is what if you get stuck at it? You get stuck at waiting. This usually happens. You think the market is at all-time highs right now and it is going to crash. It's just a matter of when. Then the market kept on continuing upwards, leaving you behind. Sad. Just imagine if you look at the PSE index right now, people in 1992 would think the index couldn't get any higher. It's trading beyond what it was before the crash. Then it went up, almost tripled its previous value. The same story for people in 2010. They thought also the market is trading at all-time highs since it's trading at the same level or a little bit beyond what it was before the crash of 2008. Then it went up again, almost tripled again in value. The same may happen as the years go on and on. Imagine if you were out of the market during that time, you would have been left out by that 100 to 200% gain. I mentioned in one of my video that by just missing out on the top 10 days would cut down what should have been a $192,000 of investment to a mere $92,000. More so the loss if you miss out on the top 40 days of the market. Instead of 192,000, it would be cut off to 23,000. Imagine that big of a difference. These are just a few days in that 70 years investment time. But if you take off those few days, your returns would be cut down massively. Now this gives us an idea that waiting for a crash may seem to be a bad idea. Now I talked about previously that yes, you can time the market if you have a crystal ball. We even have a character for that, which was Peter Perfect. Now he timed his investments so great every crash, he invested his saved up money, but I showed the difference between a great market timer compared to someone who just did cost averaging. The investment time frame was from 1993 to 2012. With someone who did a simple cost averaging, he isn't that far off from someone who waited for a crash to happen. Without any effort at all, you still matched up slightly with someone who was perfect in every way possible in timing the market. Now another study again, this time a much detailed version. This is done in 1995 to 2020. This time, timing the market isn't just done every crash. It made a bit more complex strategy, timing every dip that has happened in the market, taking the crystal ball at a whole new level. So the red dots are when our perfect investor bought shares of the index, and next to it was the cost averaging method. Like what was shown a while ago, just a little bit of difference. But we have another chart which shows a longer time horizon extending to the 1970s. This time, cost averaging beats the perfect buy the dip strategy. Why is that? Because in the 1970s to mid-1980s, the market just went up. No dips to buy in for our perfect timer investor. So imagine, even with knowing the future and all, it didn't beat the cost averaging method. Just wow, so much for the effort and time. With that said, I know most of us, if not all of us, won't be able to time every dip. No perfect investor can do that. With this, timing every crash looks like it's in a losing standpoint. Also, if you have watched my video about the summary of the book of Peter Lynch, Learn to Earn, he said, a few people can profit from timing the market. They are attempting the impossible. Nobody can outsmart the market. Now I know most of you will ask, so what should we do? Invest and invest no matter what the price is? Well, if you are cost averaging in an index, of course, just keep on investing diligently every month. Like what was shown a while ago, it's a proven strategy. It even beat the perfect buy the dip strategy. History has already showed us that market yes have cycles, but it usually goes up. Of course, indexes are somewhat a representation of the country's growth. We know yearly a country grows and grows. Well, if it's not growing, well, there's something wrong with our country now, isn't it? But we can see in the history of our country, our index does grow yearly. It has its crashes, but it recovers after. Wait, it recovers massively after. By the way, if you haven't yet watched my video about the history of stock market crashes in our country, there's a link above. Knowing history will really improve your investing journey. Anyway, going back, that's for an index investing. But for individual stocks, of course not. You shouldn't just be investing blindly over one stock no matter what the price is. The price should be in line with the growth capability of the company, its financials, and everything. So this leads me back to what I said earlier in this video. When I learned how to value companies, everything became clear. I don't need to wait for a market crash to happen to be able to invest in companies. Just look at the bigger picture. In the Philippine stock market, there are over 300 plus companies out there. Do you think all of those companies would be overvalued every time? Of course not. When I started learning how to value companies back then in 2019, even at the highs of the market, there are still companies out there that were trading below their intrinsic value. But the problem is, most investors just want to invest in popular stocks, known stocks, or hyped up stocks. Really, for them, holding a company for 1 or 2 years makes them a long-term investor. If it doesn't go up in value in that span of time, they go sell it. That's why most don't like investing in non-popular stocks. Of course, if you just look at the 30 companies or the hot stocks out there, everything is almost overvalued for you. Peter Lynch stated in his book, "This is what small retail investors have an advantage towards big fund managers. You can go invest in stocks that are not popular, stocks that have good financials but aren't yet discovered. Yes, its price may not move for 2 or 3 years, but if that company just keeps on delivering great financials, it may one day deliver what it's really worth." And you don't just hold stocks for 2 or 3 years. If you watch my analysis videos, I always look at a company's 10-year financial statement, because looking at a company's 2 or 3 years financials won't tell you much about a company. Same as holding stocks for 2 or 3 years. Warren Buffett said, if you can't hold a stock for 10 years, then you shouldn't hold it for 10 seconds, because that's the ideal time for a company to grow well. And he also said the same thing like Peter Lynch, that this is what retail investors have a huge advantage over them. They can invest in any company you want. Since your portfolio is still small, you can invest in small cap companies anywhere. Unlike Warren Buffett right now, he can't do that. That's why he is sitting in a huge amount of cash right now, because he can find undervalued companies that are large enough to make a difference in their portfolio. He can't just invest in small companies like he used to when he was just starting out. So going on, a lot of opportunity is still there even with the high market. Use the advantage of being a small retail investor. You just have to adapt in every situation, in every cycle of the market. You just need to research more to find undervalued stocks. This in turn, you won't be left behind in the sidelines. Market crashes do give more opportunities, yes, like what is happening right now. Even the large and popular companies are undervalued, but this isn't always the scenario. Another thing is being in the market or invested in the market at all times also helps because of the dividends you get yearly. If you waited on the sidelines, that money doesn't earn you dividends at all, which in turn won't compound in the years to follow. Dividends play a big factor in overall market returns. So the bottom line is, waiting in the sidelines can be sometimes more damaging to your returns, even when you compare it to when you have poor market timing, at which I also showed in my video. Really, watch it guys, there's a link above. Predicting the market is really hard. Let's face it, none of us can accurately do that. You have to adapt to every market situation, especially when you are investing in individual stocks. For index investors, this isn't a problem for you. Anyway, adapting means finding other opportunities out there. Don't just confine yourself in hot popular stocks, or don't just confine yourself investing to blue chip companies. I tell you, some stocks in the index doesn't even have good financials at all, and it doesn't mean that it's a great company, it's a great investment. Remember, you have to pay for the right price for it. With that said, don't try to time the market. Don't be a market timer. Peter Lynch has warned over and over again about market timers. Unless you have a magic crystal ball wherein you can time the market 100%. adapt to any market cycles, may it be highs and lows. With that, I hope I help you answer the question that if you should be waiting for a market crash to happen whenever you will invest. So again, if you like the video, do press the like button and please do watch my other videos as well. You can learn a lot from them. And if you haven't yet subscribed to my channel, do so right now. So see you guys in my next videos.